Thank you very much. Well, I'm very excited to be here, and I think this is going to be a very interesting panel. It's going to be a lot different than the previous panel, and that is by design, so it's not a flaw. Yesterday we had a panel that really discussed very tight labor markets and what were the benefits, what were the potential costs of tight labor markets. What we're intending to do in this panel is something a little bit different. We're going to be talking about the transmission of monetary policy. And so what do we mean by the transmission of monetary policy? Well, we've heard a lot about modeling and the tools that the Federal Reserve has. We've heard a lot about how the Fed thinks about communication, and we've heard a lot about expectations. But all that requires us to be able to make sure that the people on this panel have some understanding of what we're doing, how we're doing it, and how they process that information. So my view for this panel is a bit of a reality check on all the models that we're hearing about over the last day and a half, and how the things that we're trying to do actually get transmitted to both households and firms. So with that as an introduction, I'm going to ask each of the members of the panel to briefly describe their organizations and what they do in that organization, and then we're going to turn to a few questions. So Jen?
Thank you, sir. Janie Barrera, CEO of Lift Fund. We are a 25-year-old micro and small business lender. We are based in San Antonio, Texas. 25 years ago started there, and now we serve 13 states along the southeast part of our country, from New Mexico to Florida, up along the Mississippi River, the Black Delta, and the poorest communities in our country, the Black Delta, and also the colonias down in South Texas. I guess our customer base, over 80% are minority, about 45% are women. The average credit score of one of our customers is 580, and we have a 96% repayment rate. So last year alone, we put out $32 million in small loans. Average loan size is $25,000. Quick overview of who we are.
Thank you.
And I'm David John. I'm a senior policy advisor at the AARP Public Policy Institute, which is AARP's internal think tank. AARP is a small nonprofit with about 37 million members, looking after the interests of the 50-plus population. We also actually go beyond that because we are looking at not only the well-being of our current members, many of whom are retired or will be retiring at some point in the relatively near future. We also look after the interests of our future members to make sure that we have a strong, vibrant retirement security going forward. Many of you will either have or will receive a number of letters from us starting about age 49 or so. We work on a wide variety of fronts, everything from my area, which is more retirement security and economic security, to livable cities, what transportation options go forward, and then, of course, the ever-present issue of healthcare.
I'm Maurice Jones. I've received one of those letters. And I would like to return mine. My day job is with a group called LISC, Local Initiative Support Corporation. We're a community development finance enterprise. We work across the country, urban and rural. We've got about 35 offices around the country, including one in the great city of Chicago. And we work in about 2,000 rural counties. We invest about $1.5 billion a year in low and moderate income communities to do housing, workforce, facilities, small business. It's comprehensive community development. Nice to be with you.
I'm Holly Wade with the NFIB, National Federation of Independent Business Research Center. And NFIB is a small business advocacy association. We have roughly 300,000 small business members across the country, offices in all 50 states. I'm located in DC in the Research Center. But we advocate for our members on state and federal issues that are challenges or barriers to owning and operating their firm. I work with Bill Dunkelberg on our monthly Small Business Economic Trends Survey, where we've followed the small business economy for 45 years since 1973, asking a series of questions related to employment and outlook, prices, inventory, capital spending, and finance. We also produce a number of other surveys looking at small business operations, specific operations including how they market, how they process payroll, how they compensate employees, what benefits they're offering, and also how they're navigating some of the larger policy initiatives or laws that have been passed. For instance, we have one in the field looking at their 1 year after the tax law and how they're navigating the tax law and how their plans going through that over the last year. So we'll find that out in a few months, which will be great. But thank you for the invitation.
Thank you, Holly. So our first question is pretty straightforward, which starting with the first session, we talked about the Federal Reserve changing short-term interest rates and how that affected the economy overall. But an important aspect of that is when we're raising interest rates, how does that affect your membership? How does your membership react to that? So if each of you could comment on how you see our short-term interest rate movements affecting your membership and how they kind of process what monetary policy is doing. Janie?
Lift Fund is a community development financial institution, a CDFI, and there are hundreds of CDFIs across the country. We're not banks, so we're financial institutions without depositors. So what that means is that we have to rely on investments and donations to be able to do the work that we do. So we literally receive investments, we use that money to put out into mainstream. As the principal comes back, it's then relent out into the community. So if you think about it, where do you get those funds? Mostly it comes from banks. We have great partnerships with banks because of Community Reinvestment Act. And because of the Community Reinvestment Act is one of the reasons, they invest in CDFIs across the country. We have to pay for the cost of capital for that use of those funds. We don't have depositors. So interest rates are a big deal for CDFIs across the country because the higher the cost of use of the money, where does that cost go? Into the consumer, into the person receiving the loan in particular, or if not there, it's going to go into raising more donations to cover the costs for us to be able to use that money. There's not one CDFI across the country that is self-sufficient, meaning that 100% of our expenses are covered by the revenue off the portfolio. Lift Fund is about 60% self-sufficient. 40%, we still have to go out and get donations. So when cost of the capital goes up because we're having to spend more money, we got to find two ways to pay for that. Either fight donations or the consumer itself in raising the interest rates on the loans. So it also affects the customer because in terms of cash flow, if they're having to pay more, they're not going to be able to take on as much debt as maybe that they need to accomplish what they want to, buy widgets or grow their business or whatever that may be that they need access to capital to use it. So for the consumer, we've actually come up with different ways that we buy the interest rate down by donations. So for example, USAA is a donor of ours. We're able to get a donation from them to buy the interest rate down on the money that we have for the veterans that we lend to. So CDFIs have to become very creative in the way they're able to access capital. And so interest rates across the board for CDFIs is a very big deal.
Interest rates affect our members in two primary ways, basically in investments and in borrowing. The key question for the last 10 years has been how the low return environment has affected retirement savings. and it's been decidedly negative. Now, let me quickly say that I would rather have this than the potential apocalypse we had in 2008, so thank you for that. But at the same time, there is a long-term effect on retirement. A 25-year-old, say in 2008, could expect to save 8% of their income going forward and have sufficient retirement savings. Today, they'd have to save about 14% for the same type of a return. And this seems to be steadily going up. One academic colleague that I have great respect for suggested last week that we may have to, in the future, save as much as 20%. Now, that's just not realistic for most people because they have to live between the time they start work and they actually retire. So this is a very serious question. The price of $1 of real retirement income has virtually doubled in the last several years. Now, this is offset to some extent by what the low interest rate environment has done for borrowing. So we find, for instance, that people are able to afford better houses, they have lower interest rates on their credit cards, et cetera. And this is obviously a very strong positive because they're not spending as much on interest. But at the same time, we see retirees increasingly going into retirement with much more debt than they had in the past. So this makes them much more vulnerable going forward to any type of a real increase in inflation or the like. So what you do has a very real effect on our membership, both today and in the future. Because someone who is saving now, whether they're incredibly young, say in their early 20s or the like, or they're in their 30s, the low return environment is going to have a direct effect on how much they can build up. Even if we went back to what passes for normal in the next few years, there will definitely be a hole for everyone who is working and saving for retirement in the economy at this point. And how we're going to deal with that in the future is going to be very interesting.
I think we're a development finance entity. I think for us, interest rate rises have two potential impacts. There's a positive, which is if rates rising leads to philanthropic entities actually earning more revenue, then potentially we have the opportunity to gather more philanthropic dollars. The other side of the coin, though, is the work that we do is the work that right now in the market doesn't pencil out, right? So we are trying to finance housing for people who are earning 30% of area median income and below, up to, let's say, 120% of area median income. To the price at which we borrow dictates the price at which we can lend. And if we can't lend at a low enough cost, you can't get some housing built because it doesn't pencil out for the developer. So all that's to say is there's a potential positive impact in terms of raising dollars philanthropically, but there's a real potential adverse impact in terms of some projects won't pencil out because we can't make the loans at a low enough rate to make particularly the housing, and I'm just using housing as an example, to make particularly the housing for folks who are at the lower end of the earning spectrum makes sense for developers to construct or to preserve. So it has a real impact on the street.
Holly?
Looking through the small business lens, we ask a number of questions in our survey on financing, regular borrowing, the percent who borrow regularly, short-term interest rates, and their expectation for credit conditions going forward. Looking at regular borrowing, there is little movement when we've certainly seen short-term interest rates increase over the last few years. And so they're paying a little bit more, but it's all about the return on investment for the project that they're interested in financing. So that is the main determinant for small business owners, whether financing is an appropriate vehicle for them to pay for projects. We did a very experimental survey of 50 small business owners in an audience, and Bill Dunkelberg, or Dunk as many of you know, he asked if the Fed raised the Fed's fund by 25 basis points, would you sideline a project that you currently are thinking of developing? And nobody raised their hand. If you lowered by 25 basis points, would you take a project off the sidelines and start that project if financing was a bit cheaper? Nobody raised their hands. If by 25 basis points, if you could find a cheaper loan from one bank to another, would you switch? Everybody raised their hands. So the competition of, of finding better loan terms at a different bank, but if everything is equal, those small shifts, it's the return on investment of the project that they're looking to do is the main driver, obviously, for small business owners. In this environment with a strong economy, their main source of financing are earnings and profits. So that's the capital that they're using for the most part, but certainly credit is the lifeline, and access to credit is the lifeline for expanding small firms. But shifts in the price, it all depends on the return on investment.
So an important part of monetary policy is not just the actions we take, but how we communicate it. And yesterday we had a very nice presentation on communication. While we were waiting to get mic'd up in the other room, I asked each of the panelists, had they ever read a statement? Had they ever seen a press conference? Had they ever read the minutes? I'm not going to ask them to actually reveal what they said in that room, but I do think it highlights that when we're thinking about the various audiences we're trying to reach, there are lots of different communication tools that we potentially could use. So what was striking in the communication yesterday was there was no mention of tweets, there was no mention of Instagram, there was no mention of Facebook, there was no mention even of email. And so when you think about how many organizations are thinking about communicating what they're doing and how people actually get that information, thinking about whether our traditional way of doing communication actually has the kind of reach that we hope for, I think is something that this panel actually has a lot to say about. So I'd like to start with Holly and come back, but really focus on how do people understand what the Fed's trying to do? What kind of media channels do they look at? And do you have any recommendations for how we should think differently about how the Fed communicates its policy, since it was so clear from yesterday's session that an important part of what we're doing is actually trying to communicate to everybody that you all are representing. So Holly?
Sure. As far as small business owners, the main media source that they get their news from is through either radio or TV. So as the Fed actions get filtered through the media, that is where they're getting most of their information. I think because there is so much uncertainty about what actions the Fed takes and how that impacts markets, or the discussion about monetary policy, interest rates, it becomes very confusing very quickly for business owners understanding the links of what this all means for them, how it impacts them. Directly, it impacts them when they go to their bank and talk to their loan officer about what type of credit they're able to access at, what price they're able to come to terms with them. So through NFIB, we communicate with our members in publishing our monthly Small Business Economic Trends Survey, which we often talk a bit about what Fed policy is impacting or might impact small firms, what you all are doing. But also we go around and talk to, Bill Dunkelberg and I go around and talk to groups of small business owners, and that's always part of the conversation in talking through what we're finding as far as national trends in the small business sector, and how Fed actions influence that or don't influence what's happening, and putting it in context. So there are a number of ways we communicate with our members, but also social media is a huge component of where we look to connect with our members on all of these type of issues, in explaining everything that happens in DC to across the country. And so we were talking earlier about how I follow the Fed through Twitter, but also navigate the website and all that. But Twitter is a huge avenue for a lot of folks in digesting information and having it be a user-friendly place to access.
Holly, just a follow-up. So when you're trying to communicate with your membership, let's say it's about changes in the cost of funding, what would be kind of your ranking of how you try to reach your membership? So you mentioned radio, which normally isn't a medium that I think the Federal Reserve uses all that much. People commute or spend a lot of time in cars. You mentioned tweets and other things. If you thought about how you reached your membership, how would you rank the various ways that you do it?
Through email probably is the largest volume of information where we communicate with our members, but social media is increasing in our lines of communication. Meetings that we generally have with small business owners in various areas across the country. And those are the main sources of communication, and webinars. So that's another area that we continue to develop, is talking through what small business financing looks like, how can they best achieve their financing goals. It's a huge concern for small business owners, and a lot of times they think going to their local bank, and that's the only option, and whatever process that bank goes through in offering them terms for whatever type of lending source that they're interested in is, would be the same throughout all the banks in their area. And so making sure that they know to shop around for lending sources and credit is, an area of what we try to educate. But through webinars, that's another area that we have started to develop more rapidly.
Maurice?
Well, first, Chairman Powell, I listened to all of your press conferences. Now, what was the question? So I would echo what Holly mentioned. Technology is, for us, the medium through which we communicate the most often with our borrowers, or with folks that we're making grants to, or folks that we're making equity investments in. So all of the social media, email, videos. Now, for the residents of the communities where we work, you got to go to them. And face-to-face is the most effective way there. And so what we do there, and this is probably not as applicable to the Fed, is hold events, right? Either it's an event around a project, or it's a listening session just like this, but it's in the community, done in association with a trusted community-based organization, where we are having a dialogue and listening. So that's the other thing. If you want to talk directly to residents of low and moderate income communities, we have found that the most effective way to do that is to go to that turf and humbly have your dialogue. And so that's what I would add.
David?
We've been constantly re-examining our communications process, and we revise it rather continually. So we have older people who do basically everything on paper. We have the world's largest circulation magazine out there. But we also have increasingly members and their families who are looking at social media. So we have a major presence on Twitter. We have a major presence on Facebook. We even have a presence on YouTube. Most of our public events now are taped and put on YouTube, usually broken down into easily digestible bits and pieces. This is going to be increasingly important because I can just look in my own family as how people get news. I actually read newspapers, you know, the old-fashioned kind that are printed. My older daughter, who has 2 kids, gets hers from news websites and virtually never picks up a printed piece of paper. My younger daughter, who is in high school, gets it through a variety of YouTube commentators. These are people who didn't even exist 5 years ago. So any communication strategy that we have at AARP is probably going to be at least partially obsolete within the next 24 months. And as a result, we will be re-examining that, and we may be closing certain channels and opening others. It's a constantly churning process. Now, most of our members still get their information through the media. And a key factor is that to make sure that the media understands what you are saying. I was very struck, and I must admit my bachelor's degree was in journalism, and I started out as a news editor and coffee boy for a little paper in Northwest Georgia, that the action statement in all of the statements that were presented yesterday in yellow was in the middle of a paragraph, which makes it exceedingly easy to miss or to misunderstand. So, going forward, one of your jobs, if I may, is going to be educating the people who report on you, because that's the way most of our members and the way I, for instance, will get that information. I admit, I have never watched one of your news conferences. I apologize. I will do so in the future. Nor have I read the statements, but what I do read is in the New York Times, the Washington Post, the Wall Street Journal, et cetera, and then watch with great interest how that is translated onto the business websites that I check many times a day, and usually there is only a slight resemblance between the two. So.
Well, I'd like to share a story with you to explain what the people may think about the Federal Reserve. So years ago, when then Governor Bernanke, visited Brownsville, Texas, he literally walked the streets of the colonias and visited some of the borrowers of Lyft Fund. We were called Acción at that time. And we went to visit, and it was a little video. At that time, it was VHS, was still in. And so we went into the store, and he had a chat with him, and I explained to our borrower, the governor of the Federal Reserve, or this is Governor Ben Bernanke. And he didn't quite understand. He thought he was the governor of Texas that was coming to visit him in the store. So that is a story to kind of explain what people just don't quite understand about what is the Federal Reserve. And yesterday, when there was the discussion about the 3 audiences that you have as constituents, I agree with that. And yes, there is one message, but the way you relate that message to the 3 different groups has to be different, because you can't speak to academics the same way you speak to my mom and dad, if you will, who had a 4th and 8th grade education. So we've got to figure out how do we relay and communicate with people in where they're at to tell that story. And I think, to the Dallas Feds, compliment them, because if you go into the Dallas Fed building, there's an exhibit in the hall that's open to the public that can tell the story, that tells the story of the Federal Reserve. You go to, they have different events. We'll have events for small businesses, small business roundtables, where we ask them what small businesses are thinking, but then we also have an opportunity then to be able to tell the story about the Federal Reserve. And then most recently, Chairman Powell was in Houston because we had a thing called Hurricane Harvey that hit, and a lot of devastation. And so making the rounds to show that the Federal Reserve does care about the community specifically there in Houston. It was a wonderful event. It was almost standing room only. And so a lot of media were there and had an opportunity to visit. So I think to your point, Maurice, of going into the public And having one-on-one sessions with them is very, very important to be able to reach the communities that we want to reach.
So I thought all those were really good comments. One, thinking about broader media than we frequently do at the central bank. Maybe leading with a headline rather than burying the headline is an important point, and reaching out to communities in different ways. Just because communication is such an important element, is there anything else, as you were watching the communication discussion yesterday, did it seem at all alien? And would there be specific other comments that you'd make about how we could communicate? Because this really is an opportunity for us to think how we communicate differently, and we can be thinking about the statement, we can think of the press conference, we can think about all the various things that we do. So you've given a couple suggestions. I just want to make sure if there are other suggestions you have that we should be taking on board to use this as an opportunity. Does anybody have additional comments on how we could improve our communication? Or did you exhaust it?
Well, I was just going to say, you know, when you go to different events now, what do they have? They'll have a banner up so that you can get your picture in front of them. Did that happen here? No. Have any of you used Facebook today and sent something back to your organizations, your universities that you're here? That's how people are communicating these days, is putting things out. And just saying that you're here is an important gesture as well, because that means people are thinking. And you know, this is called a listening session, but they also have to hear from you too.
Well, and let me suggest that with the use of Twitter, which I think is a wise thing, you have differing audiences in differing ways. Most of my economics colleagues, academics, actually now use Twitter to publicize their papers and the points that they're making, and get more response from that than they do from any other source there. So this is not just a matter of speaking in 200 and whatever it is characters to the retirees who are my members. It's also a way of communicating more sophisticated ideas, usually through links in the Twitter feed, et cetera.
I think echoing that, you know, many of our communications with our members in all 50 states revolve around us going out and talking to them face to face. I know that the Federal Reserve banks do that and talk to small groups of small businesses across the country, and somehow linking it up so you can have a broader audience from which to talk to, I think would be helpful in coordinating with, you know, NFIB or other organizations that have more reach, so that we can connect and talk about the Federal Reserve and have a better have our members have a better understanding of what you do and how it impacts them. Because oftentimes with DC, it turns into a black box and it looks very confusing and unsettling.
Yes. Okay, switching gears. So we talk a lot about moving interest rates, which is the cost of credit, but we didn't have as much of a discussion about availability of credit. A number of your organizations actually spend a lot of time thinking about what the availability of credit, particularly over a business cycle. So can you talk a little bit about how people think differently about cost versus availability, and which ones seem to affect your membership more?
To underscore the fact that, again, as a not-for-profit, our customer base is not bankable. They're either underbanked or unbanked. A lot of them are in the cash economy. So 100% of our customers cannot go to the banks and get a loan. So they have to, you know, our competition is going to be credit cards or other high interest rate, pawn shops or, you know, loan places. And so availability is very important. The interest rate that we offer them, that LiftFund offers, is 10%, which is much lower than a credit card, but higher than the banks. But to the borrower, that is not the issue. Credit, the interest rate is not the issue. It is access to the capital that is the issue. And so what we've done then is we've learned how to mitigate that risk, right? Because remember I said our FICO score of our customer is 580. And so obviously bankers could not provide this loan. And so what we do is report back to the credit bureaus their payment history with us. And so we have a terrible business model as if we were a for-profit organization, because we lose our best customers. So we want them to graduate from our program and go into the traditional financial institutions. And so the interest rate to that customer at that time, the customer that we serve, is not the most important thing. It is going to be the access to capital. Now, once they graduate, then it is going to be, because now they can shop around and be able to, get a better deal somewhere else.
For most of our membership, these days, it's going to be access as more than anything else, for the simple reason that after 10 years of a relatively low interest rate environment, that's pretty much taken for granted these days. It's not, most of our members aren't going to be the ones who are necessarily going to a payday lender or something along that line. So access to credit is a key factor. We find increasingly that older individuals are taking out mortgages, and they will carry that mortgage into retirement. So the access in the short run is key. And as I mentioned earlier, should there be a resurgence of inflation or something along that line, that makes them vulnerable, especially if they have a variable mortgage. Let me say also, though, that as a regulator, in addition to being monetary policy, the recent trend to lending, both on business side, but also in housing areas and various and sundry others, to say lesser credit standards is a concern. Those of us who, I spent years in doing bank regulation and that sort of thing. It was the first 20 years of my career. And watching the diminution gradually of credit standards as individuals forgot the lessons of the previous recessions, et cetera, was and is a concern. So our membership needs access to credit, and preferably low-cost credit. But at the same time, for their long-term security, the fact that credit standards remain at a certain level is going to be rather crucial.
I think in our case, it's both. It depends on the audience that we're serving. So if we are talking about the financing activities that we undertake with respect to real estate development, where we're financing developers to do projects, whether it's community facilities or housing, the key there really is going to be price. And because we have to have the right price point in order to actually make the project pencil out, in order to make it economical. But we also serve residents directly, and for most of the residents, where you have either negative net worth or zero net worth, it's access, right? Access is the real challenge between the two. And so it just depends really for us on who the customer is that you're talking about it. And so the headline for us is both.
From what we've seen in our survey and other surveys that we've conducted on small business financing, access is by far the most crucial element for small business owners. The price component of it is certainly a concern. When we asked in 2015 in a separate survey whether the Fed increasing interest rates would impact their firm, there was a good population that said that they were concerned about it. But at least with pricing, they have flexibility of absorbing those costs in some capacity. And again, it's the return on investment of the project that they're interested in completing, and how that will increase revenue or expand their business. But it's all based upon the access to financial or to sources of credit.
So switching gears again, the central bank in the United States is a little different than many other central banks in that we have two goals. We have both inflation goal and a maximum employment goal. And there are times where that actually isn't a problem. So in the Great Recession, we had a very high unemployment rate and a very low inflation rate, so it was kind of clear what direction we were going to have to go. But there are other times where these two elements of the mandate work in opposition, and arguably you could argue that right now we're in one of those situations. We have a very low unemployment rate, which at least by historical standards was usually a period where we'd be raising rates. But we also are missing on our inflation target, where core inflation's at 1.6, our target's 2%, so that would argue that maybe we should be a little bit easier. So how does your membership think about the trade-offs between inflation and unemployment, and particularly in the current environment that we're in, where we have both a low unemployment rate, but a relatively low inflation rate? How do you think about that? Holly?
For our members and small business owners generally, having a predictable, solid foundation for dealing with inflation is probably most critical. The employment part of it is, there's so many other impacts and challenges that they have in that area, but at least having an inflation target and have stability there where it's predictable and that area does not cause them added uncertainty. When we ask about small uncertainty over government actions in our problems and priorities survey, that's in the top 5 of their concerns. So critical issues, uncertainty about what things are going to look like. So as stable as that can be for them to then be able to navigate how they operate their business and how they see expansion opportunities for themselves, I think is helpful. On the employment side, as I said, there are just so many other impacts that they have to navigate through outside of the Fed. But inflation is certainly an area that they would like certainty.
So just a quick follow-up. When I talk to small businesses, we have a small business advisory council, and I hear a lot about wage growth right now in the tight labor market. So when you're talking about inflation, is it price inflation, wage inflation, is it both? How the concerns about inflation, talk a little bit more in a tight labor market, how small businesses think about some of the pressures they see in a tight labor market.
Sure. So in our monthly survey, we're certainly seeing compensation, more small business owners increasing compensation to retain and attract employees to fill open positions, but also to retain the employees that they have. It's very competitive out there with other businesses, so they're doing everything that they can. Being able to increase their prices to compensate is the balance and the issues that they're having. But with a strong economy and strong sales, we've seen record levels of profits for small business owners, so they are able to absorb much of that cost as far as increasing compensation for their employees. But that's, how much further that can go is kind of the question.
Maurice?
Ultimately, we're in the business of fighting poverty. And so from that lens, I'm going to take on the perspective of a poor person or a person living in the low and moderate income communities that we serve. And the best thing for them is prolonged low unemployment. No question about it, because they have a better chance of getting employed, bless you, if we have that prolonged long unemployment. And that's what we've seen has been the result of what's happening now, is more and more of the residents that we're trying to serve. Now, I know there's an economic policy piece of this, so I'm gonna leave that alone. We have to get people equipped for the jobs so they can do the jobs. But businesses now are digging deeper to employ people, to find people to employ, so they're coming to us to help them prepare folks from communities for work that they were not coming to us before this period. And I see businesses being, frankly, more innovative with the folks that they have. So from the standpoint of fighting poverty, the longer we can have low unemployment, the better. That's what we wish for.
So just to push a little bit, so if we just focus on maximum employment, one of the concerns might be that over time you'd see more inflation. You might actually have the Fed have to react to asset price booms. And so when you talk about low unemployment rate as the main focus, do people that you work with think about what the ramifications would be if we push it too far, and who gets affected more by a recession? So you benefit from a very tight labor market, but many of the people that you work with are also likely to be the first ones to be unemployed in a recession. So how do they think about that trade-off that the central bank has to make?
Yeah, for the communities that we work in, recession has been a constant for years, right? So they don't fear recession, that's their lives right now. So the chance to have the opportunity to get work is the primary, without a doubt. They'll take that risk. Now, the business is a different ballgame, right? But I think we have seen businesses hire more folks that they would not have looked at before, people with records that are justice involved, people from communities of color that they would not have been reaching to. And I think we've seen that happen without inflation, and we've seen that happen, and the businesses have remained very profitable. And so I guess, and I'm not an economist, so I'll give that qualification, but the experiences that I've seen have given me some reason to doubt this great fear of inflation as a result of low unemployment. But I'll let you all figure that one out. I can just tell you that from the standpoint of giving people a chance to get work and to get a skill set experience that allows them to get out of poverty, prolonged low unemployment is what folks need. They need a chance to be hired.
Unemployment also deals with our population fairly strongly. One way that you can offset the results of low returns on retirement savings is to work longer. And one of the fastest growing demographics in the labor force participation rate is older Americans. Older Americans need the opportunity, and one of the things that we're seeing is, of course, that retirement is changing. It used to be you reached a certain point, you got a gold watch, and then it was off to whatever it was that you did for the rest of your life. Nowadays, we're increasingly seeing bridge jobs or phasing out of the workforce and the like. So the opportunity for an older American to continue to work in some capacity is increasingly important. It's also important in psychological areas. We find that there is a significant uptake or increase in the number of people who are depressed or feel alone or whatever, who have just sort of abruptly left a job. So the unemployment target is really very important for our people. One of the things that we see, for instance, is that it's not just a function of availability, because there is still a problem in the eyes of many employers with hiring an older worker, that whether the costs are going to be higher, whether the productivity will be lower, et cetera. We have a wide variety of studies that both we have done and many others have done showing that this is not the case, that actually an age-diverse workforce is much more likely to be productive going forward than just one that focuses on a certain age group. There's also a training aspect where history is passed down onto the younger employees and the like. So what you do on unemployment and the like is rather crucial for our people. Having said that, there is also a factor that a significant number of people leave the workforce before they're ready. whether this is due to healthcare concerns, losing a job. Older people have a much harder time finding a job, et cetera. So this also needs to be taken into consideration. So the overall healthy economy, the overall opportunity to work or at least find other ways to be useful is rather crucial.
One follow-up on the inflation. So some of the models that have been discussed over the last day and a half talk about inflation being over our target for a period. So let's say 2.5% for a period and then coming back down. From the perspective of your membership, how concerned are they about overshoots of inflation? Is that an issue for them or not much of an issue?
Most of them, and I hate to say this, I think this is true for most of the American population, wouldn't be aware of it one way or the other. The problem is that if you start to get back into whether it's the early to mid 70s where 6% was considered to be a very high inflation rate, or whether you get into the early 80s where you had 21% mortgages, that would start to be a real problem. But for a short period of time, slightly over, that's not going to affect that much. There is an effect always on fixed income individuals and the investments that they have. And people who are on a fixed income are going to be more affected by a higher inflation rate simply because they don't necessarily have the flexibility to either change investment strategies or make other moves.
Well, as you know, the industry that the small business industry is where a lot of the employment is being placed, right? Because they create jobs. So that's important to them in terms of finding good employees. And you know, a good example would be a guy in San Antonio. Actually, yeah, he was incarcerated like 13 years. He tells a story that when he went into jail, the mobile phone was as big as a shoebox. When he comes out of jail, it's as big as his palm. And so he had to learn a lot, and you know, decided he was trying to get a job, couldn't get a job. And so he said, I'm going to go and buy myself some tools and get a truck. And he started doing landscaping work. And one of our loan officers met him and said, hey, you're a sole proprietor. You are a small business. And so through some training then, we were able to provide him a loan. And fast forward now 8 years later, he has 3 businesses and he employs 300 people. And most of them were newly incarcerated. So that's a story about small businesses that are growing the economy through these the jobs. And a lot of them actually hire their own family and friends as well. So yesterday when we were talking about, when you all were talking about how things are captured, about someone working in one industry or one job and then transferring to another, that's probably they're going to the small businesses as well and being employed by their family and friends. So that may be something. And then on the part about inflation, for small businesses that we work with, the inflation is important, but I don't think they call it inflation. They call it cost of goods. You know, what is the price of tomatoes? What is the price of bread? What is the price of milk? And how is that affecting when I purchase to want to go and, you know, if I own a restaurant, I want to know what those prices of those commodities are. And so I don't think the general public knows what inflation is or the definition of inflation, but they certainly know when prices go up.
Mm-hmm. One last question, then I'm going to open it up for a few questions from the floor. One of the reasons we're having this listening tour is to think about what happens in the next recession if our short-term interest rates get to zero. So we talked at the beginning about how you react to short-term interest rates, but the other aspect is we did a bunch of policies, and the very first paper kind of talked about different ways that we could affect long rates as well as short rates. So talk a little bit about how you think about the long rate movement versus the short rate movement. Do you pay attention to the long rate? Do you pay attention to the short rate? And does anybody understand what it is the Federal Reserve does when we're not moving the short rate but using some of these other mechanisms to affect the long end of the market? So I'll start with you, Jean.
Well, from Lift Fund's perspective, from my perspective, it's the long rates is directly related to investors. Because remember, as I started the conversation, we have to rely on money that people invest, literally invest for a return from LIF fund. So if the long term is kind of uncertain, then people don't know whether to invest and where. And so it hurts CDFIs across the country when people are not wanting to take that chance and put in their money into a CDFI.
Great.
Well, I've said a fair amount about the effect of long-term rates on investments, and one of the factors is that it used to be in what was termed a normal return investment that when it came right down to it, you could make mistakes in investment choices, and you'd get bailed out because the overall market went up to a certain level, and that's no longer true. And if it goes back down to zero, especially in a recession economy, that's going to become even more of a problem going forward. So the long-term effect on retirees, and as I've already said, up and down the age scale is going to be a matter of concern. That's not something that, as far as I know, the Fed can deal with itself, but it is something that is going to have to be dealt with as a society and as an economy. We still have a Social Security system that has not been resolved as far as its financing goes, and that's going to be an important issue going forward. One of the things that we are also likely to see is that we have seen models, this was what Horneff, Maurer, and Mitchell, Olivia Mitchell from Wharton, have a model showing that in lower interest rate environments, there actually is likely to be a lower investment in tax-favored retirement accounts, and people will move to other types of investments instead. Now, that will have an effect also going forward. So this is actually technical, highly technical. Most of our members, 99.9% of our members, haven't the foggiest idea what the Federal Reserve does. They may look at the name on the dollar bill or something along that line, but they really don't know. They don't understand monetary policy in the slightest. But the effects of the monetary policy is going to be really crucial going forward. And I'm afraid that ignorance of your role leads right into the conspiracy theorists. And that's going to be a matter if we go back into another recession in the type of political environment that we have at the moment. You may see a rise in threats to the independence and things along that line. Not from our members.
Maurice?
I think, look, long-term rates are certainly important for us, particularly mortgages, right? And we're dealing with home ownership issues. But if you look, we borrow from banks and then relend. The average term of the loan that we borrow is 5 years or less. So the short-term rates are really more influential on us getting work done in the communities than the long-term rates are.
In our problems and priorities survey, we actually ask obtaining a long-term loan and obtaining a short-term loan. They're in different sections of the survey so that they're looking at them independently. But we ask a random sample of our members to evaluate 75 problems, and we rank the problems by their mean score. And so in 2012, their ability to obtain long-term loans ranked 65, short-term loans 68 out of 75 problems as a critical issue. 12% in 2012 for long-term loans said that it was a critical issue in operating their business, 11% for short-term loans. So they were equally kind of distributed as far as importance to small business owners. And 34% in both categories said that it's not a concern for them at all. In 2016, those two issues dropped in the ranking to 69 out of 75 problems 75 issues, potential issues, and so 69th place and 70th place. So they both just shifted down as a concern for small business owners in comparison to the other 70 or 69 issues that we asked them about, where in both categories, 6% said it was a critical issue for them in obtaining long-term and short-term loans, and 39% in both categories said that it wasn't an issue for them at all and that they weren't concerned. So the two are equally important to them, and currently not a significant issue as far as obtaining loans that they're interested in. And then zero interest rate. The concern that we have for that is that, if it constricts or is a disincentive for banks to lend based on their return of an investment for a small business loan, which tends to be more expensive to facilitate than a larger business loan. So their availability in a zero interest rate landscape might be a bit difficult for small business owners in the small business sector compared to large business owners, just because the cost associated with facilitating the loan is higher.
Great. So why don't we now open it up for 3 or 4 questions and just see if people have any questions for the panel that I didn't address in my session. So I'll start with Neil, who's right up here in the front. We have some mics. Well, maybe you can use I know you have a wonderful voice. Why don't you use that wonderful voice? And we'll get the mics going in a second. Here, Ellen has it. Here comes the...
Thank you. Thanks for the great panel. David, a follow-up question on your comment about older Americans staying in the workforce. That's, as you said, that's been an important part of labor supply. I think much to our surprise, how many older Americans have stayed in the workforce or rejoined. From the older Americans' perspective, are we at maximum employment, or are there more older Americans you think that we could still tap into?
Oh, I think there are many more people who want to work. Increasingly, we will see people who leave the workforce and discover that retirement isn't quite what they had expected, that the beach isn't there, and that they, just for social purposes, want to go back and do something and feel useful. So I think there is still room for an expansion in the older Americans.
Other questions? I saw some. Yep. Jared, down all the way down to the right. Why don't we take Randy and Jared in the back, and then I'll take one from over here, and then let the panel respond. So we'll collect 3 or 4.
I think this question is for Mr. Jones, but others can chime in if appropriate. I thought your comments about the persistence of very tight labor markets for the communities you serve were extremely resonant, especially regarding pulling folks in who might not otherwise have an opportunity. But I also know, and I wonder if this squares with your experience, in many poor neighborhoods, there are people who are even beyond the reach of very tight labor markets. They need more help getting in. And one of the ideas that's on the docket for numerous members of Congress, numerous folks who are running for office, is this idea of the government creating jobs. We have a Federal Reserve that's a lender of last resort. Should we think of the government as an employer of last resort and the kind of market failure I'm talking about? Is it your view that this would be a useful policy advance, some form of direct job creation for people who can't find jobs even in very tight labor markets?
I think it's, as long as it's a vehicle to actually get people the work experience they need to then go out and compete when the government cuts back on that, then yes. If it becomes a dependence on the government for the jobs, I think it's really risky for our population. But yes, I think the government should be in the business of work experience so folks can actually get the experience and the credentials that comes with that, hopefully, that will position them to continue to work in other places. Yeah, I think there's a great opportunity for that.
So Randy?
Hi, Randy Krosner. I want to pick up on a point that Jane had made about what we as academics and we as policymakers mean by things like inflation and what people in the world mean by that. If you actually look at like the Michigan surveys on inflation, and also if you look after the ECB was created on surveys of individuals of what they were perceiving inflation to be in Europe, they report dramatically higher numbers than we report by CPI or PCE or other means. And I think part of that may be because there's a different perception of what inflation means. We have an idea of how to create an index and think about LeSpar versus Posh indexes, all these kind of technical things. When you ask people about price changes, they may be reporting just prices that change, for example. So they report a higher level of price changes because they're not thinking about the prices that aren't moving. They're thinking about the ones that have changed and that are kind of bugging them, and because they've moved up recently. So I think just in terms of words, we're using the same words, but there may be different things that are meant. And I think inflation may be interpreted differently by bond market participants, by individual households, et cetera. And I think that's really important in thinking about communication to make that connection. And so I'd love to hear the panel think about what words do central bankers and academics use in ways that don't make sense to a broader public. I think another word or another phrase is stability. And we talk about price level stability. But to central bankers and academics, that means 2% inflation. I think most of the world uses the word stable to mean unchanging. And so I think even there's just a disconnect in the way that we do this. I think there'd be an enormous amount of benefit in terms of improving our communication if we as academics and central bankers spent a lot more time talking to people, doing basically behavioral economics, trying to understand how people interpret the sorts of phrases and words that central banks use, trying to find out whether individuals even are aware that the central bank is making actions, and to the extent that they are, how they interpret what they interpret those actions to be. This is very standard stuff that psychologists and behavioral economists do, but I think we do very little of this in macroeconomics, and I think the payoff would be very high.
So I think the question is, how do we communicate more clearly, and how do we use vocabulary that people actually understand? So I think that's something probably all of you could comment on. So why don't we just go down the line, Jane?
Well, I think we talked about it a little bit already. What technologies out there that are reaching people? The most webinars right now and blogs are the big items. And so how does the Fed create a blog that talks about these issues in layman's terms?
I think that in any technical profession, you're going to have terms that we use constantly and we use in talking amongst ourselves, and therefore assume that everybody understands what they mean. And having a simultaneous translation into English might actually be incredibly useful for all of us. But this goes to actually the point that we heard earlier, which is different audiences. Behavioral economics has worked because, and it's huge in the retirement field, it has worked because it helps people to understand how real individuals make decisions and the like. So yes, a series of research looking at how to explain to people, how to communicate to people, especially on the new types of platforms, would be incredibly useful.
When I was growing up, not too long ago, there was, yeah, there you go. Before I got this letter from this guy, there was this song about everyday people, right? I can't remember now who. Sly and the Family Stone, right?
Let the record show the vice chair knew
That's pretty good.
No, the chair said it first. The chair said it first.
Everyday people, right? Go out and observe how everyday people talk about this stuff, right? That's what you do to learn how to translate it, right? Everyday people walk into the store and the price of milk is 10 cents more than what it was yesterday. That's what they say, right? So it's how you get yourself into the shoes of everyday people. You do that by building relationships with everyday people, right? The other thing I would say is when you're talking about poor folks, poor folks are already paying more for stuff anyway, right? It's expensive to be poor in America, right? And so inflation, when you use terms like inflation and stability, it means nothing to the folks that we are dealing with, the everyday people. But I think that's the question is, what can you do to get yourself in the shoes of everyday people?
Holly, you're going to have the final word because we're down to our final 25 seconds.
I would just add to that in surveying small business owners, we have challenges in making sure that we're asking questions that they can understand. I mean, when we first started the Small Business Economic Trends Survey, instead of cost of financing, it was a more convoluted term that we used. I don't remember if it was access to capital or something like that. And our response rate was nothing, but we knew that that was something that was important to them. So why aren't they answering? It was because they had no clue what we were asking. So talking about stability, and our members would say, well, we just need it to be somewhat predictable, so we can, bake that into a budget and know that this is, something that's going to be a bit predictable for the next 5 to 6 months, and so we can navigate what sales look like and how we might balance that between paying for the new refrigerator or something like that. So, it's talking to our members. It's an area that we work on and making sure that we understand how they talk about their business. But it's getting out there and talking to the communities of the folks that are impacted by Fed policy and communicating with the terminology that they're used to.
So with that, we're out of time. I want to thank everybody on this panel for a very engaging discussion.
Thanks, everyone, for that fascinating discussion. I'm going to give a shout out to a book that I think answers some of those questions. There's Jonathan Mordock and Rachel Schneider have a book called The Financial Diaries, How American Families Cope in a World of Uncertainty, and it follows 235 families, low and moderate income families, as they navigate, navigate life in America with, how they make financial decisions. So we are going to break now for lunch. Lunch is going to be the same format as yesterday, and we will meet back here at 12:30. So look forward to seeing you all back.